What's driving this market? FOMO, fear of missing out. A little bit of euphoria, a little bit of unrealistic expectations. What happened to macro? What happened to fundamental data that normally moves the market? But none of that matters until it does. Lots to talk about. Sit back, let's go. Hello, this is Michael Loftus for Wealth and Wisdom TV, where education is the key to a successful financial future. First time here, I am a practicing financial advisor. We have a registered investment advisory firm and do act as a fiduciary. What you see here, we do apply to our portfolios, etc. So if you like what you hear, please do consider subscribing. So in the opening, I talked about it. What's driving this market? Historically, you want to see fundamentals driving the market. How about that macroeconomic data? No, none of that has mattered at all. It just doesn't matter.
It doesn't matter. It just doesn't matter. It just doesn't matter.
Now, eventually it will, but for today, no, it does not. But we are seeing a shift in the market. No matter what you hear on big TV, inflation is starting to click up again, and that is going to be an issue, especially with the Fed. So today, as always, going to go through our cycles, the macro view. We're going to go to the big charts. Take a look there. Sector spotlight. Lots of opportunity with some upside, just not in the U.S., okay? What keeps me up at night? And game plan going forward. Let's go to the big board. All right, kicking things off, little quote from the master, Sir John Templeton, the four most dangerous words in investing. This time is different, and I can't tell you how many times I've heard that or read stories about that in the last couple weeks. We'll talk about that more in a minute, okay? So, as always, our process starts with the cycles, right? Based on growth, inflation, policy. Pretty simple. Get this from our research firm. We've been pretty much in cycle 4 since the peak of 2021. Growth slowing, inflation decelerates, right? We obviously have seen that, but we have seen a change, okay? We are moving over to, at least for the next couple quarters here, we're looking at growth still slowing, okay, but inflation accelerates. Everyone got excited about that print, 3%. The problem is, coming off very high comps, now we're seeing it run back up again. We're going to show you details in a second, okay? So, going through the growth story. Right? Here we are. S&P earnings through last week were minus 8%, okay? That's not growth. Market doesn't care at this point. But again, this is what's happening. The other big piece was GDP last week. What's going on, okay? When you look at GDP, there are certain numbers we look at. Let's take a look, okay? First up is consumption. Consumption was down. Obviously, okay, investment, okay, investments in companies, CapEx, etc., went from -8 to -3.1, so less bad, okay, but the big one, and why we saw a positive number, government. Government spending has been out of control. I'll show you more details in a second. We went from 2.7 to 3.8%, doesn't sound like a lot. Government spending, that's massive. So our number, we were wrong, a lot of people were, because the government is spending like crazy right now. Show you more in a second. And then it looks at imports, okay? But those are the three main drivers of what's going on. We continue to see these going lower. Government spending, we'll see, okay, when I show you in a second, it's not looking too good, okay? The Fed, the soft landing. Everyone's talking about the soft landing. Confidence grows. The Federal Reserve is going to deliver a soft landing. Again, here's the Wall Street Journal. Same thing. Everyone talking about it, just like they were talking about inflation being transitory. I say not so fast, okay? When you look at that, soft landing. Pow, staff are no longer forecasting a recession. Again, we're talking about an organization that just doesn't hit their targets. And I hate to use the term can't be believed, but their calls over the years have been less than stellar. How's that? A little more PC. Now, very reminiscent of Ben Bernanke in 2008. Fed is not forecasting a recession. So we'll see. Right now, some people say we're in it. Again, forget about what's going on with the government. You take away the government spending, there's a lot of issues there. We'll get further into that. One of the biggest ones, and here it is, right? The deficit. We're now up to $32.6 trillion. The debt ceiling, okay, right, about 5-6 weeks ago, we have now added $1.8 trillion to the deficit. There's that spending. When I say out of control, I mean out of control. I just don't even know what to think about it. It is not mattering right now, but it will at some point. I believe that to be the case. We will see as we go forward. Okay, so next up, we've talked about inflation, right? Put this out yesterday on our social media. Link below to make sure you follow us. But look, here's the CRB index. So you've got CRB index commodities soaring, okay, in the last month or so. Lumber, copper, wheat, sugar, I could go on and on and on, okay? And then here's oil. Look at oil straight up, okay? Oil has been really gone straight up, and what's that going to affect? Is going to be inflation. We're going to talk about this from an opportunity standpoint. We have been adding back some of those inflation assets because of the stagflation call. So next up, let's go to the charts. All right, just going to show two charts on the S&P, the monthly chart, the long-term view. Said this in our last video, right? Despite what I think with the macro and fundamental side, things are being pushed, right? We know about these 7 companies, the big 7, Magma is what they're now called, right? But we have had now, right, a couple big months where it's moved up. We're negative today, first of the month, not surprising with some selling after some month-end markup. But at this point, that chart is definitely positive. All right, so next up, I'm showing the SPY ETF, S&P 500. Couple things here that I will point out real quick. At the top, might be a little bit difficult to see. I'll zoom in. Relative strength, right? RSI, relative strength. It peaked, went lower, lower. So as the market went up, that was going down. That's called negative divergence, okay? Something to watch here as we head into this month. The next thing is the VIX, non-existent. Talked about this last month, okay? ODTE, same-day options, is taking over this market. Over 50% of trading volume right now. Said this, option trading is now more than individual equities and ETFs. It's really one of the big factors that's moving the markets. But what's happened is, as ODTE, same-day options, have surged, okay, 50% of activity, 30-day options have gone down. So the VIX is based on 30-day, okay? So it's been completely suppressed, no volatility, including all the euphoria in the market. That's why this market's gone up. Now, doesn't matter until it does. You're going to hear me say that several times because eventually it will, in fact, matter. Okay, at the bottom here, I've got rate of change. I'm using a factor of 1. Okay, we're going down the longest period where we have not seen the market go down more than 1% in one day. Again, going back to that volatility, it will come. We're coming into a period where volatility seasonally is at its highest. August, September, October. We'll see what happens as we go forward. Now, next up, right, we've talked about this several times. Magma, the big 7, right? Outside of that, right, we have not seen a big surge. Now, that being said, This is the NYSE in blue. Okay, the histogram is new highs, companies making new highs minus new lows. And I'll go over here, I'll zoom in, right, to the most recent period. We're still not seeing a lot here, okay? Just a little bit. Now, a little bit better than last month, but we're talking about 100 versus if I go back here, 700, okay? So not seeing that big surge. I'm going to put on here on the screen, right, once I can get rid of this, an image of S&P. You see it going up, and those companies outperforming the S&P, and you can see that huge divergence. Again, we're not seeing this spread out, so that is something that still concerns me. Not affecting the market yet, but eventually, I believe it will. Let's go to Sector Spotlight. All right, so we have a lot to talk about here in Sector Spotlight because this is really where we are right now, okay? So from our standpoint, we feel that the U.S. markets are way overbought without a lot of substance behind it. That being said, there's a lot of opportunities. When I looked at those cycles, this is global, okay? So when you look at global macro, you look at those countries that are in cycle 1 or 2, they're growing, and there's a lot of them right now that we're taking advantage of. But first, we're going to look at the 10-year Treasury. Why is this important? I talked about this with the inflation story, okay? With the inflation story, once again, we're seeing the 10-year Treasury go up, okay? This has been an issue, okay? We've been out of Treasuries, have, I think, about 3% in Treasuries right now. But because of what's happening, right? Yields go up, prices go down. We don't see a reason to hold any type of duration Treasuries as of yet, right? And that's not going to change until this inflation story gets in check, and we're going to have to see a move to the downside, which is not happening. So let's be patient here. I've talked about this for quite some time, probably a broken record, but for now, again, we're pausing and not going to take advantage of this, okay? Next up, because of gold, right? We've been back in gold since in November. It's been a great run, but we saw a little bit of a move here in the last week or so. Took some profits yesterday, all right, because they're negatively correlated with the 10-year, okay? So as yields go up, in this case, you see today, gold's going down. So we took some profits. We've trimmed our gold miners as well. Trimmed our silver, so any type of precious metals, we're still owning, but we have trimmed them down and might even go lower here in the next week. Let's see what happens. So again, precious metals has been part of our story over the long term, but we'll see what happens, okay? So talking about some countries, what's happened, you have certain countries, okay, that took longer to get out of COVID. One of those was Japan. Now, Japan has really not been a great place for quite some time, right? If I were to show you this chart, right, it's been stuck really for 30 years. Sounds crazy, but that is the fact, okay? But as you see, we're really starting to see some growth in Japan, okay? Been slowly adding, okay? Japan is our top holding. We've got 3 different holdings. Can't give away all those secrets here, but we've got 3 different holdings today, seeing another pullback. Probably an opportunity for us to go ahead and add to our existing positions because overall, again, we see a big growth story in Japan. The next one that I'll mention, okay, is going to be Brazil. All right, Brazil. What do I mean Brazil, right? Look at Brazil, okay? Really starting to see a move here. What's going on there? Well, their overnight lending rate was like 13.5%. Massively higher than the U.S. They really aggressively went after inflation. And now their inflation's down below 4%. Okay? So as they start lowering, right, lowering the overnight lending rate, that's going to spur growth, number one. Number two is the inflation story suppressed. Okay? 3, they've announced they're going to start cutting rates. That is definitive. Going to start cutting rates. Number 4, okay, Brazil. We're looking at some oil opportunities there as well. So added there the other day. That's another one that's pulling back today. Added to it to this morning. We'll see what happens, but like Brazil as we go forward. Let me see what's next. I don't want to give away too much here. Yeah, so overall, we've got, I think we've got a total of 8 different countries that we've added. I'm looking at another one today. So again, can't give it all away here in the video for YouTube. Our clients will know about this. We'll write it in the missive here. But again, some other opportunities. We feel the U.S. Where's the U.S.? At the top with nothing behind it. Where here, when you look at Brazil and you look at Japan, great opportunities in some of the other countries that we have added as well. So next up, we'll talk about the oil story. Okay, I showed you CRB index up. Okay, oil up, starting to break out. All right, for a couple different reasons. One, we're seeing lower production. Okay, so, and inflation is popping back up and is moving up as we go forward. So here's the oil story, kind of came back, moved up here in the last month or so. So we started adding some oil last week. We added some other inflation assets, lumber, and looking, and another one as well that's also adding in agriculture. Again, can't give away all those secrets here. But we do see inflation continuing, grinding higher here over the next couple quarters. And again, another reason why we don't think the Fed is done. But this is one of now 3, and we'll look to continue to add some more inflation assets as we go forward, and really do like this sector overall. Uranium's another one, and that's all I'm going to give away at this point. So we've had some really nice success here over the last couple weeks with adding some of these. So next up, what keeps me up at night? All right, don't forget, if you like what you hear, please do consider subscribing. We also have a podcast we put out, the latest one's coming out this week. There should be a link here. If not, there'll be a link below by the time it does come out. So, what keeps me up at night? Let's go through a few things, right? Saw this weekend. Trucking giant Yellow declares bankruptcy. We're talking 30,000 employees losing their jobs. This is what we're seeing out there, folks, all over the place, right? Keep in mind, bankruptcies, the highest number since 2008. I get it. The market's ignoring it. But it's going to come a point it can't continue to ignore what's going on underneath the surface with all this macro information. Next up, I'm sure this is impossible to read. I'm going to zoom in here, but you're looking at the employment issue, and we're going from red, negative, and I'm going across the board on various states. The yellow line is the U.S., okay? And as you go forward, the dark numbers are, we're seeing growth there. And you can see across the board now, excluding Hawaii, Virginia, not surprising because of what's going on in Washington, Kansas, Kentucky, Oklahoma continue to be strong. But outside of that, we're seeing growth in unemployment in every other state, okay? Unemployment is the #1 laggard. Asset measure, okay, delinquencies on all loans, consumer credits, commercial banks. Hello, look at that, okay? Again, this is what's happening behind the scenes. You're not hearing on CNBC, etc. Now, the median sales price on houses. I mean, look at that line. Unbelievable, right? In fact, if you look in the corner here, 75% of homes in U.S. housing markets are beyond the reach of middle-class buyers. That's what's happened with all these printings. It has created this unbelievable wealth divide. Think about the average home today, $450,000, 7.5% interest rate. We're talking big numbers to be able to afford that, okay? This is an ongoing issue. So let's wrap some of this up. What keeps me up at night? When I talked about, this time is different, okay, I'm just going to show 2 slides here. The first one, as always, is the yield curve. When you look at the yield curve, right, 10-year Treasury minus the 2-year. Now, in history, okay, it has had a 100% accuracy of calling recessions, okay? Now, It's not when it comes down, it's when you see it start coming back up is when we really want to get concerned. And zooming in, you'll be able to see that. Saw an article last week saying this no longer matters, the yield curve. Doesn't matter anymore. This time's different, right? Remember that in our opening? So again, we're at negative 0.91% on that. Negative, right? When you invert below zero. This is what's happening. So the 2-year Treasury is higher than a 10-year. So again, continue to watch this. As you notice, as it starts elevating, that's when the market goes down. That's when I start getting concerned, right? Current corporate bond yield versus Fed fund rates, okay? You're now yielding only 0.12% above the Fed fund rate. Again, this comes from Tavi Costa. Thanks for the chart. Okay, when you look at that, it shows you each time. The red line is that number, okay, the 0.12. The white is the S&P. And each time we hit a low, what happens to the market? Well, but this time's different, right? Come on, this time's not different. It's never different. Yes, I do think that we have been delayed in some of the effects of the Fed raising rates because of what I showed you early. The government spending money, the Treasury refilling the Treasury account after the debt ceiling, the banks, the BTFP, right? The Fed, the Treasury giving these banks liquidity, keeping them afloat. There's been all this extra surge of liquidity in the market that was not expected, and all it's done is kick the can down the road, is our opinion. That being said, a lot to take advantage of as we go forward. Getting ahead of myself, so let's go to game plan. Okay, so game plan, a little bit different this time, right? This pullback. I think we're way overdue for a pullback right now. Saw some month-end markup. We'll see where we go here this week. Some of the data, I think that Thursday's the big one. Apple, can they produce? Can they come out with a big number? We saw with Microsoft last week being down, okay? Actually bringing reality to the market saying AI, which is the big one, is going to be gradual, not overnight. Now that pullback, let's see what happens. Remember, seasonality, summertime, August, September, October, the worst. Does that pullback create more of a pull, or is it a buying opportunity to take advantage over the short term until we see really things getting worse in the first part of next year? More to the markets than just the U.S. Again, overbought. We think there's a lot of opportunities out there outside the U.S. We continue to add to those opportunities. We'll do so today on this pullback. Metals, again, we talked about that. Let's see what happens here, okay? A little worried about the 10-year going too high, but so far, the 10-year is kind of capped out at 4%. If we could stay below that, there or below, metals should be good until we see another push there. Bonds, we've talked about that. We want to stay away until we get a clear move that yields are starting to go down and we can take advantage of the prices going up. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.